Good morning, everyone, and welcome back to Simple and Fun 360 Education Week. My name is Norman. I'm one of the product trainers here at BGL, and I'll be your host for this morning session as we cover pensions and deemed segregation in Simple Fun 360. Now, before we get into the content itself, just a few little housekeeping things to go through. Now, first thing is everyone is on listen only mode. However, if you do have any questions, then we do encourage you send us your questions. Please utilize the Q&A panel in your Zoom application. I'm joined here by a couple of my colleagues that are going to help me out with monitoring and also answering questions as we go to ensure that we don't miss anything. But also, we'll have time at the end for open Q&A. So again, if you had any questions throughout the webinar or even at the end, feel free to send that through. Also, the webinar is going to be recorded, and we'll be sending the recordings out at the conclusion of the education week. So hopefully you should get that or receive that within, let's say, early next week, ideally, for all those webinar recordings and all the slides and all the materials and everything like that. So have a look out for that. And also, if you weren't aware, we are running the Simple Fun 360 Education Week this week. This is the um, the midway point or just after the midway point of the education week. If you haven't done so already, again, you can still register for the other courses or other webinars. It is free to attend. So if you haven't done so, you can register. And regardless of whether you're able to attend the live session or not, that's okay. Simply by registering your name, that'll ensure that you will be sent all the recordings for all the sessions that we've done this week. And also, just so you're aware, we are running education weeks throughout all the other softwares that we offer at BGL. So this week is going to be dedicated to Simple Fund, but next week is going to be Simple Invest, which is another accounting software that we do for mainly trust companies and individuals. So regardless of if you have Simple Invest or not, if you were interested to learn more about it or perhaps even check it out and see how it works. It's very similar to how Simple Fund kind of operates. Next week we've got a whole bunch of free webinars that you can attend. And also after that we've got the CAS 360 Education Week. Our CAS 360 is our corporate compliance software. So again, if you want to check it out, or perhaps you already have CAS 360, you can attend those again free, and you can use the link to sign up for those courses as well. So, what are we talking about today? So today is going to be around pensions and also the concept of deemed segregation. So we're going to start off today by talking about starting a pension and some of the things that you have to be aware of in the program before when you're processing the pension commencement of one of your fund members. After we go through that, we'll cover deemed segregation. So we'll talk about ways you can record how exempt current pension income is calculated. So we'll go through and summarize the segregation method, the proportionate method, and also what deemed segregation is, and why you might decide to use one of the other methods to calculate exempt pension income. But we'll also mention about disregarded small fund assets. Now, all those terms are very important to understand because going forward now, when you're applying for actuaries, these are questions that you have to answer when you make your application. And depending on how you answer these questions, you're going to get different results for your actuarial percentages. So we'll talk about how that looks like in the program and then things that you'll see when you're processing this and things to consider perhaps for your funds. Okay, so let's start with pension commencement. Now, when you're processing a pension commencement, the actual act of changing a member into pension in the software is quite simple. However, there are a set number of prerequisites, I would say, that we advise all users to follow. Now, the reason for these prerequisites is to ensure that when you start a pension in the program, you're getting the most accurate as possible member balance for your members before you start a pension. And this could apply to any other processing within a fund. It could be regardless of whether you're doing a rollout or a pension commencement or even a member transfer balance between different members or member accounts. We do recommend doing these prerequisites. Again, they're specifically there to ensure that you get the most accurate member balance before you do one of these events. So the first thing that we recommend to do is to ensure that you've recorded all your income, expenses, and events before the pension starts. Again, now these are all the transactions and things like that that would have an effect on the member balance before you convert that member balance into a pension account. Now, when we talk about events, I'm more specifically talking about things like corporate actions. So making sure that not only have you done your um, income and expenses from your bank statements. But if there are any corporate actions, whether that's dividend reinvestments or buybacks or anything like that, that you've recorded that as well, as long as those things have occurred before the date of the pension commencement. Now, I've got a side note about writing back tax effect accounting. We do understand that most funds don't utilize tax effect accounting, but I put that as a side note there because it is something that you have to consider specifically for pension commencements. So if you're not aware of tax effect accounting, what it does is it creates a provision on your balance sheet for future tax or for deferred tax. Um, Now, if you want to know if your fund is using tax effect accounting, you simply go to the balance sheet and see if there's a deferred tax liability or a deferred tax asset on the balance sheet. Also, if you look at the fund detail screen, there is a tick box for tax effect accounting. So those are the really only two things that you're looking for to identify whether a fund is using tax effect accounting. Now, how does this tie into pension commencement? Essentially, if you have a fund that is going into a pension phase, meaning by extension, that fund is no longer or maybe paying less tax in the future, you might have to determine whether tax effect accounting is going to be appropriate or not for that fund. So in a lot of cases, you might decide to turn that off. Now, finally, it's creating entries. So you've recorded all the transactions up until the day of the pension commencement. Then you create entries. Now, remember, create entries, what it does is your profit allocations, market revaluations, and allocates to your members at whichever date that you specify. So you'll create entries just before you record the pension commencement, and that'll ensure that you have the best or most accurate member balance before you start a pension commencement. So let's go into the software and cover um, and show you an example of creating entries and things to think about, but also go through the process of starting a pension. So I've got a fund here. The fund is mostly in pension. We've got one member in accumulation. We're going to start a pension on the 2nd of March, 2014, 2024, sorry. So from the left-hand side, let's say I've recorded all the transactions and I'm done all that there. We're going to go to the left-hand side, compliance, and we'll go to period compliance. Okay, now this is our create entry screen. Now, with the create entry screen, you've got the create entries date, and you can adjust the create entries date to whichever date that you want it to be. Again, we're trying to get the most accurate member balance before the pension starts. Now, which date that you do create entries to is a question that we get from our clients. Now, if we're going to be starting a pension on the 2nd of the 3rd, 2024, the rule of thumb is you create entries one day before the event. Okay, now there's a couple of ways you can remember this. You can either think, okay, one day before the event, that's one way of going about it. Another thing you can think of is what is the last day that the person's in accumulation, for example. That's another way you can think about it as well. Personally, I like to think one day before the event. So if I am doing this on the 2nd of the 3rd, Then I'll create entries to the 1st of March of the 3rd, 2024, and click on create entries. Okay, so again, the create entries process goes relatively quickly. Now, once that's done, I finalized until that point. It's given me the best possible calculation of the member balance as of that particular date, and I can go ahead and start a pension. So from the left-hand menu to start a pension, we go to member and we head to our member list. So in this fund, I've got Tony. Tony's currently in accumulation. Now to start a pension on the right-hand side, you've got your new member account and we can select new pension account and start a pension. Now this will open up a new pension wizard. Now with our wizards, you simply have to work your way down the screen, answering whatever question that it does ask you. So it's as simple as just filling in the appropriate fields. So the start date will be the day that Tony is going to be in pension. Starting from that date, what type of pension they're going to be um, running, confirming that it's Tony that you want to convert into pension. Sorry, I put in the wrong date. Let's update that. Conditional release. So what reason do they satisfy to be able to be a pension account? So we'll go to age 65, let's say. We're going to say that the full balance, you do have the option to either say the full balance has been used or no, and you can specify how much of the account is going to be used as well. So for this example, we'll say yes, and we are going to cease the accumulation. We're going to say that Tony's not going to make any contributions in the future. Also, you'll have a breakdown of the components, so the tax-free and taxable components, and also the preservation components. Now, by going to full pension, the program will default to moving everything to unrestricted non-preserve, so giving them full access to the funds. However, you do have the ability to overwrite if you wish to do so. Also, you have the rollover components, which you can override as well. So if you want to adjust the rollover components for whatever reason, you can do so. By default, the program will do that based on the member balance there. And then finally, at the end, you can click on save and save only or save and prepare documents. Save and prepare documents will give you access to a letter and a minute. Now, if you forget to print off these documents, no stress there. The documents will actually be saved in your report screen. So you can always go back to your report screen and generate these sets of documents. Okay, and there we go. We've got Tony in full pension. Now, a question that we often get is around the credit entries that we did previously. So remember, I've finalized at one point within the financial year and I've created entries. And now a question that we get is, should I reverse those create entries and then I can create entries from the 1st to the 7th to the end of the financial year, or should I keep those create entries? Now, there is kind of two answers to this question. I would say in terms of how the program operates and how the create entries program function operates, you can do both. You can actually reverse entries and create entries for the full year, or keep the create entries and create entries for the full year. However, we would say best practice in the program is to not reverse entries. Now, the main reason for that is because by creating entries partway through the year, you essentially give the program a bit of a warning message in there. So, for example, the problems that might happen with, especially with pension commencements, is if people accidentally record transactions in the period before the pension commencement after you've processed it. So maybe you've edited transactions or you've added extra transactions. Now, if you add or edit transactions in that period before you do the pension commencement, it may have a material effect on the member balance that you would have started a pension with. Now, by having the create entries locked in or not reversing it, if you try to post a transaction in that period, the program is going to give you a warning message saying, hey, are you sure that you want to do this? So if you have been reversing entries, it's not a big deal. The program is sophisticated enough to remember that you've done this process before. However, just to avoid user error or anything like that, we recommend highly that you do not reverse entries in those cases. So I would say for everyone here going forward, I would suggest that best practice is to not reverse those entries if possible. Okay. Now let's go into the next topic of discussion for today, and that's around deemed segregation. But before we go into deemed segregation, we'll talk about the different calculations of exempt current pension income. The first one we'll talk about, just as an overview, is the segregated method. So this is something that we talked about in one of yesterday's Education Week webinars, where we went through the segregation dashboard and allocating assets to specific pools. Now, with the segregated method, if you're segregating the whole fund, anything segregated to a pension account, that's going to be determined, all that income is going to be determined as exempt pension income, whereas anything allocated to a accumulation member will be as taxable income. The proportionate method, the next method, this is essentially you getting an actuarial certificate. So you haven't allocated specific investments to specific people in the fund. You've just recorded everything and everything's as one big pot. At the end of the year, you'll apply for an actuarial certificate. It will give you a percentage and it will apply that percentage across the entire financial year. Now, usually that percentage is going to be based on the total fund liabilities and the pension liabilities as well. But with each actuarial provider, they do differ slightly with their calculations. And then thirdly, we've got the deemed segregation. The deemed segregation, it works very similar to the proportionate method, but with one major difference. And the major difference being under deemed segregation rules, if there is a period of time within the fund that all the members are in pension, then it would deem that period as fully pension. So you still get an actuary certificate, but that actuary certificate is then only going to apply for that period of the financial year where there was an accumulation and a pension account. And then it will ignore that period that you've got all your members into pension. Okay, so let's illustrate how that kind of looks in terms of a timeline. And this is our example on the 1st of March, one of the accumulation members converts from accumulation to pension phase. So here, let's say it's a two-member fund. You've got one member in accumulation, one member in pension, and at one date they all go into pension. So under our proportionate method, you will get one actuarial certificate, and that will apply for the full year regardless of the kind of the how the fund is looking at a particular point in time. Now, there is a proportionate method and there's a deemed segregation method, and they did apply within different financial years. So if you were working on funds from 2017 and previous year, it was strictly only that proportionate method that we were using for all our funds and whether using segregated method. But when we're just talking about actuarial certificates here. However, in 2018, they made a change. So from 2018 to 2020, they decided all funds are going to be using this deemed segregation. So what would happen is you would still get an actual certificate, but how it applied to the fund was very different. It would only apply that percentage to all the income and expenses that occurred at that first part of the year, whereas everything at the back end of that year would then be 100% pension. Now, there were, I guess, pros and cons to this. The biggest pro is that you now had the opportunity to think about when transactions were timed. If you could time transactions, like let's say income, especially at that portion of the year or when all the members are in pension, you essentially gain all that exempt pension income in that period. Now, having said that, there were a lot of funds at the same time that were not in that position to be able to process things as they go and weren't able to, I guess, forward think because they were maybe trying to catch up with each financial year. So they really, I guess, missed out on some of the benefits that you'll get by using deemed segregation. So after the 2020 financial year, a decision was made to allow funds to choose between either using the proportion method or the deemed segregation method. So you can go to a fund and you can now choose whether the portion method works. You get an actuary certificate applies to the full financial year, or an actuary certificate that applies for only part of the financial year. And you can claim the rest of it as pension as well. Now, before I show you how this works in the program, there's one more term that you need to understand because it applies to your application for actuary certificates, and that is your disregarded small fund assets. Now, although they gave us the choice of picking between proportionate and the deemed segregation method, they've also added this bit of legislation that you have to consider as well, and that's disregarded small fund assets. Now, with disregarded small fund assets, it's a bit of a maybe poorly worded bit of legislation, but essentially, what it is a bit of legislation that prevents certain funds from being able to use any of the segregation methods. So that includes the when you segregate the assets to members or whether using deemed segregation. So if a fund can answer yes to all of these questions, that means the fund can only use the proportionate method, essentially, is what it's saying. So under this, the conditions are the first one, does one of your members have pension? Your second one, fund member is total super balance. Does one of your members have a total super balance over 1.6 million at the start of the financial year? The third thing is that member with over 1.6 million also in pension? And the fourth one is the fund not in 100% pension throughout the entire year. So that is all the members are in pension. Okay, so those are your four things that you're looking at. Okay, so do you have a member, basically, do you have a member over 1.6 and is that member in pension? Usually is the main things that you're looking for there. But if you can answer yes to that, then the fund is locked within that proportionate method. Okay, and that's just kind of what I've just talked about there. All right, now let's go into applying for an actuary. Now we've covered those bits of theory. Let's go into applying for an actuary, and you'll see those questions pop up, and that's what it applies to, that theory I've just talked about there. Now you apply for an actuary if you have at least one accumulation and one pension member throughout the year. And the second point, just to clarify, is you only need one actuary certificate or one actuary percentage for the fund, and you will apply for this actuary certificate at the end of the financial year. So you've done all the transactions, you've done all the processing, whether that be depreciation, corporate actions, all that stuff you've already done. Now, with applying for an actuary, another question that we get is, do we need to create entries before applying? And for the most part, you don't need to create entries. However, there are some exceptions with some of the providers. So Heffron and Verus are the exceptions. So if you utilize Heffron and Verus, you will need to create entries before applying. So let's go into the program again and start processing a a actuarial application. So I'm in the fund here. Both members are in pension, or all members are in pension. Deemed segregation can apply to this fund, let's say for this example. To apply for an actuary certificate, we go to member and fund pension policies. Now, in our fund pension policy screen, on the top right hand side, we go to new actuarial certificates. We go request and we select which financial year that we want to apply for. And then we click on request actuarial certificate. We'll ask for support for the provider as well, so we can select whichever provider works for you. Click on next. It'll ask you for your contact details, and you finally have the option of those extra questions as well. And again, this ties into some of the stuff that I was talking about there. Now, the first thing it's going to ask you is confirming whether you're eligible to use a segregated method or not. So remember, you've got those dot points that I've talked about. Do you have a pension member? Do you have somebody over 1.6 million? Is that person in pension? And was the fund not in 100% pension throughout the entire financial year? Now, to help you make that choice, we'll also list down the total super balance for each of your members in the fund. So you'll be able to see that instantly then. Hopefully that makes it a bit easier to answer that question. So in this case, we're going to say that the fund is eligible to use the segregated method. So it doesn't answer yes to all of these dot points. And then you've got your choice between using the proportionate method or using the deemed segregation method. Now, use picking between the two options will give you a different actuarial percentage because the actual percentage will apply differently. Okay, so just remember that. So we're going to use the segregated method and we'll show you how it's a little bit different when you're looking at the screens. We're going to click on Submit to Actuary. That's going to connect to your actual provider. Now, if you haven't got an account with them, it will ask you to set up an account first. But once it logs in, it will pre-fill the entire application for you. And you simply have to confirm whether that yeah, you want to request the certificate or not. I'm not going to do so, not right now. I'm going to go back into the program and I'm going to have a look at the pension policy for that year. So after you've clicked on submit, and not to like request it and to pay for it, it'll give me a breakdown of the estimated percentage, but also how it applies to the year as well. Now, because I've selected deemed segregation method, it's giving me a 45% actual percentage. Now, this percentage is given to us directly from the actual provider. Some of the actual providers do offer you an estimated percentage. Okay, so not all of them, just keep in mind, but a lot of them do. And by sending you a percentage, you'll be able to identify whether, the fund is looking like how you think it's supposed to look. But also you get an idea of what kind of a fund exempt current pension income the fund is going to have. Now, also, because I've selected deemed segregation, you'll have this segregated method area that's filled in. It will have the segregated period. So it's been able to identify that from the second of the third all the way to the end of the financial year, that entire year is 100% tax exempt. Also, you've got the ability to select your expense percentages as well. So whether you want to use the ATO formula from the legislation or whether you want to use the actuarial percentage as well. But also keep in mind that the percentages also work like with the deemed segregated method. So it'll only look at that period for when the fund had accumulation and pension members. So we'll click on save. And we've got that there. So again, from this point, you would, if you're happy with it, you would go and determine and pay for the actual certificates, and then you'll receive that and mark it as completed once you do receive it. Now, a question that I get here is how can I utilize the program to get the best, I guess, tax position for my clients or the fund that I'm working on. Now, there's a couple of ways you can do it. And especially because we've got the ability to grab estimated percentages, and the estimated percentages don't vary too much, usually from what the actual percentage is going to be, we can utilize that feature to get the best out of the fund. So one way of doing that is determining whether deemed segregation or the proportionate method is best for you. So because I haven't submitted it and paid for the actual certificate, I can go ahead and go through the application again, and this time selecting the proportionate method instead of the deemed segregated method. And this way, it's going to give you a different percentage. Remember, because it's applying differently to the fund. So this time it's 63%. But I don't have the drawback is I don't have that period that that is deemed to be segregated as well. So again, as you can see there, the percentage does change. But what I would say to you is after you select your method, go ahead and create entries to the end of the year. Have a look at your tax return and your balance sheet, see what the result is, then come back, try the other method and see what works better for the fund. And the same thing happens with the general expense percentage as well, because you've got ATO formula, you've got actual percentage. Now, what I guess clients would normally do is select the ATO formula because they already know what the actual percentage is going to be. Use the ATO formula, create entries to the end of the year, see what the program calculates, and determine whether that is going to be better than using the other percentage. So if I go back to the fund pension policy screen, it's giving me 100% on there. So maybe using the actual percentage might be better for this fund. Okay, so remember, because the actual percentage and the ATO formula do calculate things differently, but under the legislation, you can use either or. Um, you might have to kind of test and see what kind of works better for your specific fund that you're working on. So if I was using this fund, in this case, I would say using the actual percentage would be better for this fund here. Okay. Now, lastly is reapplying for an actuary certificate. So let's say, for example, that you've done all your processing, you've taken it to your auditor, and they've said they found some issues, or you've possibly found that you forgot a few transactions. Now, that's okay. You would go through and make any changes that you want. But just to clarify, when you go and need to reapply for an actuary certificate, as far as what you do in the program, nothing changes. So you still go into new actual certificates, request actual certificate for the year, request, and you go through the process again. Now, because we've got this integration with these providers, we've been able to do a lot of that stuff on the back end to indicate that you're resubmitting for a particular fund. Okay, so hopefully that makes it a lot easier as well. So that's pretty much the end of the content today. I've got a slide there just talking about some of the things to think about, whether you're using the proportion method or the deemed segregation method. So things like when are transactions occurring? Have you been able to get a lot of the income and capital gains to fall within the segregated periods or not? And do also the expenses and capital losses, do they occur when there's an accumulation balance in the funds? And that usually helps you determine which one is going to work better. But again, as I've talked about, you can easily reverse and recreate entries as many times as you need to use that estimate percentage to determine what is easier for the fund or what is better for the fund. So yeah, I'd like to say thank you for joining us today.